Well, good afternoon, everyone. For those of you who don't know me, my name is Jess Holland, and I have the absolute pleasure of chairing this expert investment panel. So we're here today to talk about the gold mining industry and also the investment opportunities that there are. And to help us with this discussion, we have Campbell Olsen, who is the Executive Director and CEO of Arete Capital. Next, we have Rob Curtis, who is the Investment Director of EMR Capital. We also have Paul Crooke, the Managing Director and Head of Mining and Metals Investment Banking Australia for RBC Capital. And finally, we have Ben Clifford, who is the Portfolio Manager of Argonaut Gold Fund. So, welcome. We have quite a bit to cover, so let's just get started. So, it's clear, being at Kerry's Australian Gold Conference, that we have quite a few gold bugs in the room. So I thought we would start with you, Campbell. What is your investment thesis for gold, and what are your reasons to invest?
Go long.
Okay.
Go long. Gold's always been terrific in turbulent times, and I think fair to say there's a fair bit of turbulence around. There's a disconnect. I mean, we're long production, and we like that, so that's good. It's served us well for quite some time, but at least a decent part of your portfolio, even our portfolio, is in gold production.
Yeah, fantastic. And Rob, what about you? What is your sort of investment thesis and reason for investing in gold?
Yeah, so I guess we're similar in terms of EMR Capital. We're a private equity fund, and so we are also, echo those words, very long gold. But I think in terms of portfolio makeup, both PA, personal or professional, gold really, we view it as an essential part of a diversified and balanced portfolio, and we only really invest in 4 commodities, and gold is obviously one of those, and being a part of that balanced portfolio makes sense, but it's a liquid commodity, and so we manage a closed-end 10-year fund, and so we need the ability to be able to exit liquid markets, and gold provides that, and there's a few other factors which I think some of the other discussion topics will draw out, but in terms of availability and access to market, I mean, investors have a range of options and available to them to invest in gold, but really, from our perspective, a little bit like what Campbell said. I mean, it's a hedge against, and there's plenty of economic and political turmoil going around, and I think that historically has proven to be where gold is a good part of a portfolio makeup.
Yeah, so just jumping over to you, Ben, what do you think are sort of the key, reasons in your mind for why the gold price could potentially go up?
Yeah, I think historically there's been a range of drivers, but for us the most important is that combination of inflation expectations, real interest rates, and also where the US dollar is set to land. And I think we're kind of in an interesting environment at the moment in as far as we've seen possibly the fastest rate of nominal rate increases in over 30 or 40 years. And that's put us at this juncture now in terms of if we go any higher, it's highly likely that we'll see disruption in terms of the financial system. We saw that in Q1 with SVB and also Credit Suisse. And going back through history, where you do see that financial disruption quite quickly, you see central banks respond. So from where we sit, it's an interesting juncture. There's probably longer term developments that are favourable for gold, but it's not something that we sort of really rest our investment thesis on right here, right now. But last week's announcement in terms of BRICS doubling its size in terms of counterparts or members of that trading bloc to 6, additions, including Saudi Arabia, for us that's a really strong, I think, impetus for the prospect that the US dollar might not be the world's reserve currency in the future, and also from a trading perspective there's clear motivation for members of BRICS and new members of BRICS to move away from that from a transactional standpoint. But again, that's much longer dated, so at the moment, I think markets are very closely watching where we head in terms of both nominal and real interest rates.
It's so interesting. There's certainly a lot of noise coming out of Saudi Arabia now, or coming out of the woodwork. So now, Paul, coming from a slightly different angle here, since you work with mining companies, what do you think motivates gold producers to keep doing what they do, which is to mine gold?
Yeah, look, good question. And I think one of the things an important element to call out from the perspective of us or our clients, which, as you say, are Australian mining companies, is generally speaking, mining companies don't like to predict or project the gold price because that often is a fool's game, and anyone that says they can predict where the gold price is going is probably lying. Otherwise, you probably wouldn't be in a position to be talking to them. But I think, and it's also important to call out that where we're at the moment, US dollar and Aussie dollar gold pricing is pretty close to historic highs, given, for the Aussie dollar, particularly given where the exchange rate is. However, notwithstanding that, I think you've got, in Australia in particular, the Australian gold mining companies have a history of very high technical capability, some of the world's best underground and open pit miners, some of the world's most efficient, productive underground miners in particular. And so, our clients, the Australian gold space that people in here no doubt invest in, back themselves to continue to extract margins, even in a rising cost environment, by leveraging probably world-leading skill sets in particularly underground mining, but also open pit.
Yeah, so interesting. Couldn't agree more. So now we've discussed some of the positive reasons for investing in gold. So let's now discuss some of the more contrarian views. So starting with you now, Rob, what do you think are the key risks involved in investing in gold?
Well, like I said before, investors have a range of options in terms of how they get exposure to gold. I think the obvious one is short-term price volatility. And if you look back over the longer term, the gold price is generally going in that direction. And I guess one of the executives and commentators in the gold space that I do pay attention to the most is Jake Klein at Evolution, and he will, I know Paul is right, anybody that thinks they've got the crystal ball on what the gold price is going to be is probably lying, but it doesn't stop everybody from the Uber and taxi driver and everybody else saying that they'll tell you what the gold price is. Jake's point is that there is a very strong correlation with US debt, and we know where that is headed. And so, his confident prediction is that the gold price is going up, and over the longer term, it does do that. As my chairman would say, it's going in a northeasterly direction. But there is clearly short-term volatility, and, we're in a market right now where, we were talking earlier, and I'm sure it's a conversation point with everybody in the room, but I can't remember a gold market like this. And there's a few reasons for that, but the tide really feels like it's gone out on gold at the moment. But I think there is a tremendous opportunity, and whether that's 6 months, 3 years, 5 years from here, we will look back at this as a tremendous opportunity to get set in gold, because I don't think it will last. And there are other factors around whether it's, in Canada, they've had crypto and cannabis, and at the moment we're in the grip of battery metals and lithium, and I'm not saying that'll go away, but gold has kind of been shunted to the background. So a very long-winded way of saying, Jess, I think short-term volatility is something that investors do need to be aware of, and it really comes down again to the individual makeup of somebody's portfolio, and one, how you gain exposure to gold, and then two, what your time frame is. Because if you had exposure to gold in 2011, in 2015 you're probably not feeling too good about yourself. But if you got exposure in 2000 and you're still holding, then you're feeling very good about yourself.
Yeah, I think there's room for investors to have, all of those in their portfolio, the critical minerals, but also gold. Yep. Yeah. What do you think, Campbell? Do you agree with what Rob's saying, and how do you manage the risks of investing in gold?
Oh, look, I'm in fierce agreement with Rob. We actually don't hedge at all on our production, and any economics professor will tell you in Australia we're tightly correlated to the commodities price anyway, and that we have not had any issue in 6 or 7 years with that. And on the volatility, there's lots happening in the world that we're not really seeing. Simple things like, Basel III and the elevation to Tier 1 status of gold. What's that going to do? 100 to 1 paper in the ETFs, 100 to 1 physical. How's that all going to be backed out of the US? And they've been blocked from the European. And just not sure. There's just so much stuff going on around the world that hasn't kind of filtered through to your point, that's out there. It's on the runway, you can see it. And I'm just not sure which car's going to get smashed. So that's an issue for us. Yeah. Have a look forward, but we just have to rely on the 5,000 years of solid history of gold, I think. And the crypto's the same, and the move the BRICS, 1st of January, the Russians put out their first, gold-backed settlement currency, which the BRICS will adopt. That's going to be really interesting to see what happens there, because there's just not enough gold. Yeah. So there's only 1,000 tonnes a year on average produced. So I think overall there is some volatility. I think it's a positive runway. I hope it's a positive runway, put it that way, because we're long in it.
Yeah. One of the other things, Jess, and to your point, Rob, and yours as well, Campbell, around pricing, notwithstanding, the comment about trying to predict the gold price, there's obviously demand and supply when you're thinking about any pricing scenario. Demand side of gold, I think, is really, really difficult to get a good handle on, for anybody to get a good handle on, because there's a big jury element to that, remains very big, but then there's the marginal pieces historically, which is the central bank buying and speculative buying and the safe haven buying, which is hard to predict all of that. The supply side is different and easier to predict and to assess, because you can observe it. You can see the mines that are producing, you can observe the geology, and the important element there is grade is only really going in one direction. Global resources of gold, grade is declining. And that, if you isolate that element in terms of gold pricing, that only points the gold price in one direction, because you need to move more dirt to get the same amount of gold, which means greater cost. So there's upwards pressure from the supply side on the gold price.
Yeah, so you've sort of answered my next question to you, Paul, to an extent. From a gold mining, producer perspective, how do, gold producers mitigate some of the risks in terms of the price volatility? How do they manage those?
Yeah, so one of the obvious ones Campbell alluded to was hedging, and it's quite easy for gold companies to hedge their exposure to the gold price in the financial markets in a short to medium time frame. However, gold investors typically invest in gold equities because they've got a positive view of the gold price, and gold hedging therefore is generally a bit of a dirty word. Most investors don't like companies to hedge unless it's a prudent amount, because they've got a large amount of debt on their balance sheet, or they're embarking on a new project which requires a lot of capital investment. But aside from that, gold companies try to avoid it because investors do not like it. And so what that means is, again, related to a similar point I've made, companies therefore focus on what they can control, which is their costs and the supply side, and driving themselves as far down the cost curve as possible. I think a few years ago, or maybe call it 10 years ago, the Australian gold sector was a pretty high cost producer, generally speaking. Australian gold companies then did a very good job of driving back down the cost curve, and there were a lot of sort of first and second.
How have they done that, though? I mean, we're in this high inflationary environment, so how have they been able to achieve that?
Well, what I was going to say is it's actually reversed a little bit, unfortunately, and Australia has become, by and large, there's plenty of exceptions, a reasonably high cost mining jurisdiction again, because of the inflationary pressures, particularly, a large proportion of the gold produced in Australia comes out of Western Australia, which has probably felt cost pressures maybe more than other jurisdictions. But I guess the challenge is on the sector to try and bring back the productivity improvements that it's been known for in the past, target higher margin ounces. I think the sector is, in the past, gravitates eventually towards ounces over profitable ounces, which can bring companies unstuck to an extent. So it's targeting profitable ounces, which is an obvious comment, I guess, and bringing back productivity improvements but it's tricky in an inflationary environment.
Yeah, I think, as you say, Paul, I mean, your best protection, Jess, is where you are on the cost curve. And it gets crowded down there because everybody says they're in the first quartile. So I don't know where everybody else is, but it's very crowded in that down there. But, and, you know, I think when you talk to investors, generalists, gold price is obviously, you know, something that you see on the news most nights of the week and so on. And like I said before, everybody's got an opinion. And so $2,000 US gold price, $3,000 Aussie gold price, people assume, oh, you gold miners must be making lots of money and great times. And well, it's actually the margin erosion from underneath because of inflation and labour market, etc. That is, it hasn't been as profitable, and it's not at the moment as profitable as what you intuitively think.
Yeah, thanks, Rob. Now, just jumping back over to you, Ben. So, as a portfolio manager of Argonaut, how do you and your gold fund mitigate the risks of gold volatility and the, you know, producer costs and inflation?
Yeah, I think it's pretty much everything for us in terms of how we risk manage our portfolio. And I think you have to be acutely aware of where you're at in the cycle and where sentiment is at. And so it feels for us at the moment, and again, we don't try to have heroic predictions in terms of where the gold price is going. We tend to observe rather than predict in terms of prices and respond accordingly. And right now, that range feels like 1,800 to 2,000 US an ounce, and we're probably in the middle, a little bit higher, and that feels like it's going to see some support. But a lot of it comes back to liquidity and how we size positions accordingly. And sentiment really does drive liquidity. And some stats I was looking at this morning, so the lithium space, Alchem, $9 billion market cap, it's trading $70 million a day. Northern Star, $12 billion market cap, and it's trading circa $50 million a day. And if you go right down the market cap curve, that is magnified in a pretty large way. So that shortage of liquidity, capital, it influences your cost of capital. And ultimately for us, how we think about position sizing is key. And, you know, if you boil that right down to a sort of example right now, you know, if we're looking at that lithium exploration space, there's no shortage of capital because sentiment is very, very constructive. You know, we're currently invested in Aura Gold, which is a really interesting exploration play. And from a liquidity perspective, it's not really seeing the same level of demand purely because, not a function of the resource or the opportunity, but purely a function of sentiment. So those sorts of dynamics really do influence how we think about position sizing. And it's critical. I mean, you look at the GDX since its May high, as of yesterday, it was down 21%. From May high to yesterday, we were down 4%. Calendar year to date, we're sort of plus 11. GDX is marginally higher, possibly flat. So there are opportunities for active managers, but within that, it's intrinsic for us that you play great defense. And I think that really is linked back to position sizing and having that very strong visibility around, you know, the fundamentals, management, grade, resource, location, geography is becoming much more important. There's a lot of stranded gold reserves. So for us, there's a really important risk element to what we do.
Yeah, it's so interesting how, you know, the different commodities go through commodity cycles, and, you know, the renewable technology is really driving the critical metals sentiment. But, you know, gold still has very, very strong fundamentals in terms of investment, which has, you know, been over decades. So this isn't a new thing. This is something that's solid. And anyway, moving on, I think let's talk about some of the different types of gold investments. So starting with you, Campbell, what is your particular investment style in gold? You know, is it active, passive? Yeah, what do you guys?
Well, we're very active. Pretty much everyone in our fund comes from an operational background. And so we take very active roles, and we're an evergreen fund, which means we don't have a closed-end date, which gives us a lot more flexibility to plan over the long term. So we're looking for, you know, production assets, generally production assets that other people don't want. And the Stawell Gold Mine's a classic example, and no one wanted it when it was for sale. And it's been a fantastic performer for us since we rebuilt it. And quality longer term projects that can feed into the back of those core production assets, where, you know, particularly in gold and in, you know, we're getting some pressure for these transition metals. You know, I don't know where it's going to transition to other than copper. I mean, who knows what's going to get up? Some bloke will invent a plastic battery in his backyard next year and then all that'll be gone.
Well, it takes 23 years on average to get a copper company from discovery through to production.
Oh,
So
I know that, don't worry.
Yeah, I mean, I know
very
you
well.
know, sorry, you're the
And that's in a
professional.
good regulatory environment. So, you know, we focus, you know, on, I don't know which projects are in the pipeline. You know, what we've discovered is the project economics, when you're looking at these things, are less correlated to the underlying fundamental commodity than they are to the economics.
Yeah.
So in these days of confusion where you've got scope 1, scope 2, scope 3, and you've got car companies coming in taking the mining roles and investing everywhere, and the big miners fighting back and all sorts. So it's great to be a meat and a sandwich because they fight it out. We make good money out of that. But, you know, we focus and say, right, okay, given all that, we don't have a crystal ball, so we focus. One thing you can be short of is if there are only a few projects that are going to get up, they're probably going to be the ones with the best underlying economics in the future. So, you know, we look at that with a little bit of sort of jurisdictional sovereign risk issue over the top, not worried about operational capability because you can build that with good people. So they're the two main focuses, you know, the various production assets which are flanked by medium and long-term project supply to give you a long-term sort of 10, 20, 30, 40-year horizon over these assets, and that in itself creates a lot of value for people.
Interesting. So now, Rob, going over to you, from a private equity perspective, how do you, you know, choose which gold investments to go for?
Yes, so look, unfortunately you're going to get a very similar answer to what Campbell just said, because the way we manage our gold investments, I mean, at the end of the day, and something that probably gets lost, and again I'm borrowing from Jake Klein, but I mean gold is still the second largest metals market, commodity metals market on the planet behind iron ore, so it is still very relevant, and that gives us the confidence as a private equity investor with a closed-end fund. The thing that probably troubles private equity the most is the ability to exit. Anybody can invest money, but from our perspective, we need to go in with an investment thesis, create or unlock value, and then exit. And so, you know, the gold market is a very liquid market. There are a number of gold companies, and they're always looking to improve the quality of their portfolio. So, in terms of, by way of an example, to answer the question, finally, Jess, I mean, our exposure to gold at the moment is the Ravenswood Gold Mine in Queensland, which is a joint venture with the Indonesian Singapore group. And we bought that from Resolute Mining about 3 or 4 years ago, and that was non-core, a little bit similar to what Campbell mentioned with Stawell. That was non-core. I mean, Resolute had, you know, pretty firmly hitched their star to the West African wagon, and that was, you know, that's become the centre of their universe. The next phase of that asset's life required a fairly major capital commitment. So we did our due diligence and saw a tremendous opportunity. It's in a great jurisdiction, a good location more locally. It has required a lot of capital, but that asset has been completely transformed, and most of the outside world won't know it yet because of what it was when Resolute owned it compared to what we've done. But now that is now ramping up to be a 200,000 ounce per annum producer. And again, fast forward to the end bit for us is that we will need to exit our position at some point. That point is not yet, but it will be coming in the next sort of 12 to 24 months. And the beauty is that an asset of that scale in a jurisdiction as Australia, but then Queensland as well, and given the location, we're confident that that will be a market, and then, you know, we can explore the options, whether that's a trade sale or an IPO, or and choose our preferred path. But that's, again, we are owners and operators. We look for non-core, unloved assets that we think have still got value, and roll our sleeves up for on average sort of 3 to 5 years, and then, you know, try to daylight value creation through improving the asset and then exiting. And so, as owner operator of assets, that's how we're a very hands-on investor as well, much like Campbell said.
A lot of finger crossing on the exit.
there's always that thing.
Technically got that-
Yep,
that
there's certain
happening
things
all
you
the
can't
time.
control, such as weather, etc. But all you can do is just control the things that you can control.
Yeah, absolutely. And I think jurisdiction, while you can't necessarily control geopolitical risk in any jurisdiction, you can certainly pick and choose ones that,
Yep.
would be safer investments. But it's interesting that you mentioned Indonesia, because one of our keynote speakers that spoke earlier this morning, he mentioned 3 jurisdictions being Indonesia, Vietnam, and India, was it? And it's just really interesting. He spoke of those as being some really key economies that are growing and sort of coming out and into their own. So really, really interesting.
Yep.
Watch this space. Paul, so over to you now. While your clients don't have a particular investment thesis because you're working with mining companies, perhaps you could touch on how gold producers ensure that their operations are sustainable and poised for growth.
Yeah, I guess how mining companies or our clients ensure their operations are sustainable from an operating perspective. I assume you're not talking about sort of sustainability, the buzzword, but I can touch on that as well.
No, not ESG, more from an investment perspective.
Yeah, I think I think it's about targeting profitable ounces, investing in the drill bit, which in different parts of the cycle, mining companies pull back investment because it's hard to allocate capital to exploration, which has an uncertain return. But it is important. Most high quality ore bodies that have been operating for a long time will continue to operate if you invest in the drill bit. Geology tends to extend, and so it's about remaining committed to that investment, I think, and I guess sustainability and having a sustainable operation and being sustainable is also about making sure your investors continue to support you and come along for the ride and support you when you want to when you need capital, go and grow. And so I guess that's about ensuring that you're continuing to return capital or at least generate returns for your investors. On the large S sustainability front, I think the mining sector can get a bit of a bad rap in certain instances, but the gold miners actually rate pretty well, relatively speaking, when it comes to sustainability and particularly the E when it comes to ESG, because essentially a small portion of gold miners generally, certainly in Australia, their Scope 1 emissions, or a small portion of their emissions are Scope 1, which is typically from their diesel trucks, which will be phased out presumably in, call it a decade or so. And the rest of their emissions are typically Scope 2 from using the power grid, which, if the world goes the way everybody wants it to go and the grid gets entirely greened, then gold miners will be in a position, certainly in Australia, where they have no emissions. And then the other elements of ESG, like mining companies generally have historically, apart from a couple of bad exceptions, done a fantastic job of being sustainable because they have to be, because typically they operate in regional areas where they rely upon the support of community. And if they're not a sustainable miner and operator and they don't respect the communities within which they operate, they won't operate. And so that's why they, by design, they have to be good community, good sustainable operators, and they generally are.
Yep, and remembering that gold mining has happened over centuries. So, it was one of the first commodities to be pulled out of the ground. So it's kind of like your gold miners have to lead the way in terms of sustainability in mining. Just interesting. So Ben, just over to you. In terms of, being a fund manager, how does Argonaut Gold Fund, choose how to invest in gold? Do you look at EFTs? Do you look at buying physical? What do you guys do?
Yeah, so as an active manager, and we're open to wholesale investors, $50,000 minimum, open-ended, we have a daily scorecard because we're purely invested in the listed market. Some days it's terrific being a dedicated gold, precious metals fund manager, some days less so. And I think if you look at the last month or two, we've seen a very, very skittish gold sector. Caught up with a CEO this morning and he got a pretty strong message from an investor, no more good news, because any good news around the prospect of investing for the future isn't taken that well by the market right here, right now, because the market wants to see cash conversion and no risk to that, and free cash flow yield is everything. And go through earnings season, we saw it yesterday from Ramelia's stock is now back above where it was post-announcement. Earnings, KCGM expansion earlier in the month, Northern Star's result, pretty clean, comes out with a bit of a re-rate in terms of the share price post. So that skittishness really is something that we try to look through. It's important for us to go through that really bottom-up process, management, mine, grade, jurisdiction, et cetera, but also for us, we're very flow aware. And in that, I'm talking about making sure that we understand and have a good handle on different windows in time whereby a register might be transitioning from exploration to developer to producer. And within that window and rotation of ownership, you do see opportunities. And I think that's something that we're seeing currently actually in terms of Genesis seeing a bit of a re-rate from the market ahead of potential ETF inclusion in the US. So if they go into the GDX, estimates are that it could be upwards of 5% of their register needs to be bought. If they go into GDXJ, incrementally a bit more. However, if you go back through time, which we do as students of history and markets, quite often post-inclusion into ETFs, etc., you will see a period of underperformance from that equity. So that coupled with other key indices, FTSE, MSCI, locally ASX 300, etc., there's a lot of nuances in terms of the listed market that as a retail investor, it's pretty tricky to be across that and get your arms around, but that's our day job. And a lot of that, again, comes back to our ethos around playing great risk management, but great defense.
Yeah, well, I mean, for investors out there, excuse the pun here, but this is absolute gold in, advice here. These are, experts in investment in kind of coming from very different angles. You've got private equity, fund managing, so yeah, I mean, just golden nuggets from. I have one final question from our expert panel, and it's something of a bit of a personal kind of experience question. And I'll start with you, Rob. So, Rob, over the course of your career, what has been your biggest investment blunder, and what did you learn from that?
Okay, I suspect I will probably speak more from a personal perspective than a professional perspective.
That's fine.
And you may laugh, but I think just given my exposure in a professional sense, being a geologist, gold has been terrific to us. So that was really the foundation of, I spent 10 years with Rio Tinto and then joined the company called Oxiana, which some people will remember. And the cornerstone of Oxiana was the gold plant in Laos at Sepon. And that really allowed us to start small, easy, and it goes back to a lot of the things that are great about gold in terms of footprint and not needing ports and railways and all those sort of things that you need for bulk commodities. So you can, there's a reason that sort of 50% of the global exploration dollar and development dollar still goes into gold. And it's because you can be accessible and you don't need railways to get commodities out. So that was, what a location to build a gold mine. And from that, we built the copper mine, and then we built a $6 billion company. And so, and then Oz Minerals, and then EMR, and you go back to Indonesia. Our most successful exit, or one of our successful exits to this point, was a gold mine in Indonesia. And I don't think there's many Western groups that can sit around and say they've had a terrific experience in Indonesia. You certainly won't get that response in Canada. But we have. And so gold, in a professional sense, has only been a positive experience. But the Rob Curtis and ComSec portfolio has been quite different. And I think it probably goes back to a couple of the points that Ben touched on. And I don't think these are points that are unique to gold, but I would go back to management, quality of management and jurisdiction. And that's probably where I've come undone. Trusting the jurisdiction where, in hindsight, nowhere's easy, and Australia's not without its issues, but probably trusted other jurisdictions a bit too much, and things can change. And some places you just feel like you need to sleep with one eye open because you don't know what you're going to wake up to the next day. And then quality of management. Again, that's not unique to gold, but and probably the area where that's been most troublesome is that transition from explorer to developer, and the unwillingness of management during the exploration phase to hand over the steering wheel to somebody who's very capable of building a mine. That's a very different skill set, and very, very few people have the ability to transition and do both successfully. So, I mean, sometimes it takes the 25-year apprenticeship that I've done to try and work things out, and I think I'm getting better at it. I wish I could live my life backwards in some respects.
Yeah, that's so interesting.
I do things differently.
Ditto, especially with crypto. That's another conversation. But what about you, Campbell? Have you experienced something similar?
Oh God, where do I start?
Professionally or
Just
personally,
thinking of this,
whatever.
this long. Similar to Rob, regulatory is a real issue. We have a big foundation exposure in Victoria. Need I say more about the regulatory environment? And it has sort of, we've managed it, but it's, our assumptions were all completely wrong on how supportive the environment would be, particularly in a regional environment where you are the largest economic input, and you basically fund the entire region. So in Victoria, our best friends are Regional Development Victoria, not the Mines Department, which doesn't exist anymore. So, we're always when we're looking at stuff, we're always really sharply focused on the regulatory environment, not only today, but where it could move. We were not long in the stall asset when our mining minister came up and said, Campbell, thank you, Arete, thank you for everyone. You've done a great service to Victoria. This is wonderful economic development, jobs, great, and here's your 2.75% gold tax on the same day. Just blindsided us. And that's of revenue. So, and that'll probably go up again given how bankrupt Victoria is at the moment, no doubt. And I think the other main thing is people. If you get it right, it's fantastic. But if you don't get it right, it can, capital's precious and can cost projects significantly, exponentially more in outcomes if, you don't have the right people. And we all say that, but, and a lot of them come across really well and all that sort of stuff. But, when the rubber hits the road, it makes a massive difference. And if you've got good teams, you can achieve great things. If you've got average teams, well, you're not going to really achieve much. But then again, I used to say good people are hard to find. I just say even average people are hard to find at the moment. So there's just not a lot of them around.
Yeah, that's so interesting.
I know someone sitting in the audience would agree with me right away.
And, Campbell, going back to Rob's point of management teams who run exploration companies versus development companies versus producers, so different, and they all have to kind of pivot. So if you look at an exploration company, for example, they almost have to be geos/investment bankers because they got to hustle for money all the time because drilling's expensive and, commodity cycles go up and down. And then you've got your developers and they've got to kind of have these global networks to try to get offtake partners to joint venture with them and raise millions of dollars to build a plant. So I guess the management team, 100% agree with both of you, Campbell and Rob, that having a solid management team and investing in that team, in their experience and particularly the right experience at the right time for a particular company in their development life cycle is so important.
That's no doubt about it. And it's a bit like oil and water, really. When you think about it, you've got your geo exploration team over here, then you've got your engineers over here. Sorry, Rob. Sorry, Lee. we like to keep the geos in that exploration area underground where they don't have to talk to anyone. And we let the engineers do the work, and build the business. You'd agree with that, wouldn't you?
A little bit of competition.
I'll take this up over a beer with you later.
Yeah. As the engineers, we say, well, we go to your shareholders and say, we can do anything you want. It's just a matter of money. How much money have you got?
Yeah.
So, well, we don't have any money, but we want all of this. So, okay, well, come to some agreement somewhere along the line, I guess.
Yeah. So, Ben, over to you in terms of, so has there been any sort of investment decision that you or, Argonaut has made that hasn't gone exactly to plan? And, what did you learn from that, or how did you kind of mitigate the downfall of that?
Yeah, I mean, in a T+2 listed world, it sort of feels like it happens every other week in as far as outside share price moves for a variety of reasons. But I think one thing that we keep coming back to is intrinsically how well does the company that you're invested in from a market perspective really manage the messaging, and how effective are they at that? And there's some great examples of that at the top of town. So Capricorn's very, very good at it. They're renowned for under-promising and over-delivering. Down the smaller end of the curve, I think Barton Gold's done a very good job on that front. But last month we were caught out Silver Lake. It was frustrating for us. A little bit of a bait and switch in terms of the messaging or the focus. And again, in terms of risk management, it wasn't the end of the world for us, but at the same time, that was a healthy reminder in as far as how you're assessing management. And that's a pretty broad sort of statement, how you're assessing management. But part of that is how well they manage the market, and that's a really key input.
Yeah, really interesting. Now, Paul, also, again, a slightly different angle for you, but in the context of, gold producers, have you ever experienced any situation where you've provided some advice that went south, or?
I don't think there'd be too many investment bankers that would admit that, and I won't be one of the first. But maybe, framing the answer slightly differently.
That's okay.
I think, thinking back, I probably wish that in certain instances, myself, but also the teams that I've worked on, were a bit more aggressive in our advice to companies in certain instances in what they were prepared to pay for an asset. And this might be a bit unpopular with some of the people on the stage, but what I'm referring to is there have been instances in gold where opportunities over the last, call it, 6 or 7 years, where Australian companies have had opportunities to buy what are objectively tier 1 assets. And you can make an argument. I did a piece of analysis recently, posed the sort of hypothesis, is it possible to overpay for a tier 1 asset? Interesting bit of analysis, because on the empirical evidence, depending on how you define all that, you can make an argument that it is impossible to overpay for a tier 1 asset. And what is a tier 1 asset? Low risk jurisdiction, long mine life, large scale, low on the cost curve. A couple of instances you can point to, I think you can point to, when Evolution's getting a lot of airtime, hopefully the boys buy us a beer, but when Evolution acquired Cal, I remember the market perception was they have significantly overpaid for that asset. When Saracen acquired half of the super, and that was company transforming, I think, for Evolution. When Saracen acquired half of the super pit, I remember the conventional wisdom at the time, the sticker shock was that is a very big price. In hindsight, that completely transformed that business, created a lot of value for shareholders ultimately. Recently when Regis acquired 30% of Tropicana, the perception was, and probably still is to an extent, they overpaid for that asset. But all of those instances, you could argue they are tier 1 assets, and what that did for Regis at the time was what they probably had to do. And so I guess the point is, the answer to the question is, I think in certain instances, and it goes against the theory and against the valuation methodology, but maybe we should be encouraging mining companies, gold mining companies, in the rare occasions that tier 1 assets become available, to really push the boat out and pay a price that wins you the asset, because invariably these assets, lives continue, geology continues, they continue to operate through cycles because they're first quartile, second quartile assets. You can look back, invariably they continue to, they grow, that the lives extend, and therefore the value that you think they are when you buy them, the value is actually significantly greater. You're only limited by your modelling capability.
Absolutely, and I think it's really going to depend on when a particular investor wants to realise their investment. What's the time frame? If you're looking for a short-term punt, or medium term, or long term. So I think with gold, over the trajectory, don't quote me on this, but if you've stuck in it, you're doing okay. And you go through the cycles. But yeah, very interesting. Thank you so much, all of you. I think we've got 38 seconds, so anyone have a very quick question? Kerry might kill me. thank you, all of you, for your time and your insights. Really appreciate having a chat with you guys.
Problem.
Thanks, Jess.
Yeah,
Thanks.
Till next time.